Look, I need to tell you something that most people holding silver ETFs don't realize until it's too late. And when I say too late, I mean the moment they try to actually get their hands on the metal they think they own. Because here's the uncomfortable truth. If you're holding shares in a silver ETF, you don't own silver. You own a promise. And in the kind of market we're heading into, that distinction could cost you everything. Let me explain what's really happening here, because this goes way deeper than most investors understand. When you buy shares in something like SLV, the iShares Silver Trust, you're not buying silver. You're buying a financial instrument that's supposed to track the price of silver. It's a derivative. And the fine print in these prospectuses, the stuff nobody reads, it's absolutely terrifying when you actually dig into it. I pulled up the SLV prospectus last week. Page after page of legal language, but buried in there is this gem. Shareholders have no right to receive physical silver. None. Zero. You can't walk into their vault and say, "I'd like my silver, please." It doesn't work that way. You own shares in a trust that owns silver. But you, personally, you own paper. Or more accurately, you own electrons on a screen representing paper claims on silver that you'll never touch. Now, why does this matter? Because we're entering a period where the difference between physical metal and paper claims is about to become the most important distinction in precious metals investing. And I can prove it to you with what's happening right now in the silver market. The COMEX, the commodities exchange where silver futures trade, they've got a problem. A big one. Their registered silver, the stuff that's actually available for delivery, has been dropping like a stone. We're talking about inventories that have fallen from over 150 million ounces a few years ago to under 50 million ounces today. Meanwhile, the open interest, the number of contracts that could theoretically demand delivery, represents over 900 million ounces. You see the math problem here? There are claims on roughly 18 times more silver than actually exists in deliverable form. This is what they call paper silver. Contracts, ETF shares, allocated accounts, unallocated accounts. All of these are just claims. And when everyone holding these claims decides they want the actual metal at the same time, that's when the system breaks. That's when you find out that your ETF shares aren't worth the silver they're supposed to represent. Let me tell you what happened in March 2020. Remember that? The pandemic hits, markets are crashing, and suddenly, everyone wants physical precious metals. Gold, silver, platinum, you name it. And something fascinating happened. The price of physical silver coins and bars shot up to $30, $35, even $40 an ounce in some cases. Meanwhile, the spot price, the paper price that ETFs track, was sitting at $12. You had a 200% premium on physical metal over paper. Why? Because paper silver is abundant. Physical silver is not. People holding SLV watched the price on their screen say $12 and thought, "Great, silver's cheap, I'm buying more." Meanwhile, people trying to actually buy physical silver were paying triple that amount and waiting 8 weeks for delivery. If you owned SLV during that period and tried to convert it to physical, you couldn't. The ETF doesn't work that way. You'd have to sell your shares at the paper price, then try to buy physical at the real price, losing 60 to 70% of your value in the process. But it gets worse. Let's talk about what these ETFs actually hold. SLV's silver is stored in vaults in London primarily. It's held by HSBC and other custodians. Now, here's where it gets interesting. That silver isn't just sitting there waiting for SLV shareholders. It's part of the London Bullion Market Association system, the LBMA, which operates on something called unallocated accounts. In an unallocated account, you don't own specific bars of silver. You own a claim on a pool of silver. The bank can lend that silver out. They can lease it. They can use it for their own trading operations. Your silver, the silver backing your ETF shares, could be in 10 different places at once through the magic of fractional reserve bullion banking. It's the same game the regular banks play with your dollars, except now they're doing it with precious metals. I talked to a bullion dealer last month who's been in this business for 30 years. He told me something that should terrify anyone holding paper silver. He said, in 2008, we had clients with allocated accounts at major banks. These were supposed to be specific bars with serial numbers assigned to them. When they tried to take delivery during the financial crisis, The banks couldn't produce the metal. They offered cash settlement instead. The bars didn't exist. They'd been leased out, sold, hypothecated multiple times over. This is the dirty secret of the paper-silver market. The same ounce of silver can be claimed by multiple parties. Your ETF says it owns it. A futures contract says it owns it. An unallocated account holder says they own it. A leasing arrangement says someone else owns it. But there's only one actual ounce of physical metal. When the music stops and everyone tries to sit down, most people are going to find out they're standing. Now, let's talk about what's driving this to a breaking point. Industrial demand for silver is exploding. Solar panels use silver. Every single one. Electric vehicles use twice as much silver as regular cars. 5G infrastructure, it's silver intensive. The green energy transition that governments around the world are pushing, it requires massive amounts of silver. We're talking about industrial demand that's projected to exceed total global mine supply within the next few years. Meanwhile, silver mining isn't keeping up. Most silver comes as a byproduct of copper, lead, and zinc mining. When those operations slow down, silver supply drops. And we're seeing mine closures, declining ore grades, and underinvestment in new projects. The primary silver miners, the ones who actually dig silver out of the ground as their main business, they're producing less today than they were a decade ago. So you've got surging industrial demand, declining mine supply, and on top of that, you've got investment demand starting to wake up. People are realizing that silver is massively undervalued relative to gold. The gold-to-silver ratio, which historically averaged around 15-1, meaning 15 ounces of silver bought 1 ounce of gold. That ratio got as high as 120-1 during the pandemic. It's come down since then, but we're still at 80-1. Silver is cheap, really cheap. And when investors figure this out, when they start trying to buy physical silver in size, that's when the shortage becomes obvious. Here's what most people don't understand about silver versus gold. Gold is primarily a monetary metal. Central banks hold it. Investors hold it. Some goes into jewelry, but most gold ever mined still exists in bars and coins somewhere. Silver is different. Silver gets consumed. It goes into electronics, solar panels, medical applications, and it's gone. Used up. The above-ground stockpiles of silver have been declining for decades. We're using more than we're producing, and we're using it in ways that don't allow for recycling. The U.S. government used to have a strategic silver stockpile of billions of ounces. It's gone. Sold off decades ago. China's been buying silver for years. India's a massive consumer. The physical metal is flowing east into strong hands, while Western investors are content to hold paper claims. And when those paper claims try to convert to physical, that's when you get the squeeze. I want you to imagine something. Imagine 10% of SLV shareholders decide they want physical silver. Just 10%. SLV holds about 500 million ounces, so that's 50 million ounces of demand hitting the physical market. The entire global investment-grade silver bar and coin production is maybe 200 million ounces a year. You'd be trying to absorb a quarter of annual production in a matter of weeks. The premium on physical would explode. The ETF price would stay low because it's tracking paper, and shareholders would be trapped, unable to convert their holdings into the real thing. This isn't theoretical. We've seen it happen in smaller markets. Palladium in the early 2000s, rhodium more recently. When physical shortages develop in precious metals, the paper price becomes meaningless. The real price is what you can actually buy metal for, and that can be multiples of the spot price. Now, I know what some of you are thinking. But my ETF is backed by physical silver. They have audits. They publish bar lists. Yes, they do. But here's what those audits don't tell you. They don't tell you if that silver has been leased out. They don't tell you if it's been pledged as collateral for other obligations. They don't tell you if the custodian has the right to substitute bars or settle in cash under certain circumstances. And most importantly, they don't tell you what happens in a force majeure event, a market emergency, when normal rules go out the window. The prospectus for SLV has a clause that says, in the event of certain market disruptions, they may suspend redemptions. They may settle in cash. They may do whatever they need to do to protect the trust. Not to protect you, the shareholder. To protect the trust and its service providers. When things get crazy, and they will. You're going to find out that your rights as an ETF shareholder are pretty limited. Let me tell you about something that happened in the nickel market last year. The London Metal Exchange, one of the most established commodity exchanges in the world, they had a short squeeze in nickel. Prices went vertical. And you know what they did? They canceled trades. They reversed transactions that had already settled. They changed the rules in the middle of the game to protect certain participants from losses. If they can do that with nickel, what do you think happens when silver goes into a genuine shortage? The exchanges, the ETFs, the banks, they're going to protect themselves. Not you. Here's another thing. ETFs have management fees. SLV charges 0.5% a year. Doesn't sound like much, but that comes out of the silver holdings. Every year, they sell a little bit of the trust's silver to pay expenses. Over time, your share of the silver backing your ETF shares is slowly declining. You're being diluted. With physical silver in your possession, there are no ongoing fees, no management expenses, no custodian charges. You own it outright. And let's talk about counterparty risk. When you own an ETF, you're exposed to the financial health of the sponsor, the custodian, the authorized participants, the banks that handle the creation and redemption process. If any link in that chain breaks, you've got a problem. We saw this in 2008. Lehman Brothers was an authorized participant for several ETFs. When they went under, it created chaos in the ETF market. Redemptions were frozen. Prices disconnected from net asset values. It was a mess. Physical silver in your possession has no counterparty risk. It's not someone else's liability. It's not dependent on a bank staying solvent or an exchange staying open. It's yours. In a real crisis, that matters more than anything. Now, I want to be clear about something. I'm not saying ETFs don't have a place. For traders who want to speculate on silver price movements, who want liquidity, who want to get in and out quickly, ETFs can work. But if your goal is to own silver as a long-term store of value, as insurance against currency debasement, as a hedge against financial system instability, then paper silver is not going to do what you think it's going to do. Quick aside here because this is relevant. If you're sitting on a significant retirement account, $100,000 or more, and you're thinking about how to get real precious metals exposure, I put together a free guide on how gold IRAs work. It's in the description below. Covers how you can get physical gold and silver into your retirement account without triggering taxes or penalties. It's worth looking at if you want actual metal, not paper claims, in your retirement portfolio. Anyway, back to why this matters right now. The silver market is setting up for something we haven't seen in decades. You've got a supply deficit that's getting worse. You've got industrial demand that's accelerating. You've got investment demand that's still relatively quiet but starting to stir. And you've got a paper market that's massively over-leveraged, with far more claims on silver than actual metal available to deliver. When this breaks, and it will break, the people holding physical silver are going to do very well. The people holding paper claims are going to learn a very expensive lesson about the difference between price exposure and ownership. Because in a real shortage, price exposure doesn't help you. You can't use your ETF shares to manufacture solar panels. You can't use them to make electrical contacts. You can't use them as money if the financial system is in trouble. They're just numbers on a screen. I've been watching the silver market for a long time, and I've never seen it set up like this. The fundamentals are screaming shortage. The technicals are showing accumulation by smart money. The sentiment is still relatively bearish, which means most investors haven't figured it out yet. But they will. And when they do, when the rush into physical silver starts, the ETF holders are going to be left holding the bag. Think about what happened with GameStop, AMC, those short squeezes in stocks. Now imagine that happening in a commodity market where there's an actual physical shortage, not just a financial squeeze. The paper price could go to the moon, but if you can't convert your paper into metal, what good does it do you? You'll be watching the price on your screen go up while being unable to actually acquire the physical silver you thought you owned. The smart money knows this. That's why central banks hold physical gold, not gold ETFs. That's why billionaires who are buying precious metals are buying bars and coins, not shares. That's why countries like China and Russia have been accumulating physical metal for years. They understand that in a crisis, Paper promises aren't worth the paper they're printed on. Or in the case of ETFs, the electrons they're stored in. Here's what I think happens next. Silver prices start rising as the supply deficit becomes undeniable. Industrial users start panicking about securing supply. Investment demand picks up. ETF inflows increase. But here's the key. Those ETF inflows don't translate into equivalent physical buying because the ETFs are using the same silver over and over through the magic of the LBMA system. The paper market keeps expanding, while the physical market stays tight. At some point, someone big tries to take delivery. Maybe it's an industrial user who can't get supply through normal channels. Maybe it's a sovereign wealth fund that wants physical metal. Maybe it's a group of investors who figured out the game. They start demanding physical delivery from the COMEX, or trying to redeem large blocks of ETF shares for metal. And the system can't deliver. Not at these prices. Not in these quantities. That's when you get the force majeure declarations, the cash settlements, the rule changes, the extraordinary circumstances clauses in the prospectuses get invoked, and ETF shareholders find out that their shares aren't redeemable for physical silver after all. They're just paper claims that will be settled in cash at whatever price the authorities decide is fair, which will be nowhere near the real physical price. I'm not trying to scare you. I'm trying to prepare you. Because this is coming. The math doesn't work. The supply isn't there. The claims are too large. And when markets break, they break fast. You don't get time to adjust. You don't get a warning. One day everything seems fine, and the next day the rules have changed and you're stuck. If you own silver ETFs, you need to ask yourself, am I trying to trade silver price movements, or am I trying to own silver? If you're trading, fine. ETFs give you liquidity and ease of execution. But if you're trying to own silver, if you're buying it as a long-term hold, as insurance, as a store of value, then you need to own the physical metal. Not shares, not claims, not promises. The actual metal. And I know what you're thinking. But physical silver is a hassle. I have to store it. I have to insure it. I have to worry about security. Yes, you do. That's the price of actual ownership. But you know what's a bigger hassle? Finding out during a crisis that your ETF shares can't be converted to metal. That the silver you thought you owned doesn't actually exist. That you're just another unsecured creditor in a bankruptcy proceeding. The premiums on physical silver right now are still relatively reasonable. You can buy silver eagles, silver maples, silver bars from reputable dealers at $3 to $5 over spot. That premium is your insurance policy. It's what you pay to own the real thing instead of a paper claim. And when the shortage hits, when premiums explode to $10, $15, $20 over spot like they did in 2020, you'll be glad you paid that premium now. Storage isn't as complicated as people think. For smaller amounts, a home safe works fine. For larger amounts, private vault storage is available at reasonable rates. You can use allocated storage where you own specific bars. You can use segregated storage where your metal is kept separate from everyone else's. The key is that you control it. You can go get it if you need to. It's not in some bank vault in London that you'll never see, backing a paper claim that might not be honored when it matters. Here's the bottom line. The silver market is broken. The paper market has created claims on far more silver than actually exists in deliverable form. Industrial demand is rising. Mine supply is falling. Investment demand is waking up. And when this all comes to a head, the people holding physical silver are going to be in a very different position than the people holding ETF shares. You can't eat paper. You can't use paper claims to manufacture electronics. You can't use ETF shares as money if the financial system is in trouble. But you can do all of those things with physical silver. It's real. It's tangible. It's yours. No counterparty risk. No redemption clauses. No force majeure provisions. Just metal. The choice is yours. You can keep holding paper claims and hope that when you need to convert them to physical, the system will honor those claims. Or you can own the real thing now, while it's still available at reasonable premiums, and sleep soundly, knowing that what you own is actually yours. Because I promise you, when the shortage becomes obvious to everyone, when the premiums explode and the ETFs start having technical difficulties with redemptions, you're going to wish you'd made the switch earlier. The silver market is sending signals right now that most people aren't seeing. The smart money is accumulating physical. The paper market is getting more leveraged. The supply deficit is growing. And time is running out to position yourself on the right side of this trade. Don't wait until everyone else figures it out. By then, it'll be too late. The physical metal will be gone, and you'll be stuck holding paper promises that aren't worth the screen they're displayed on.